Good morning, everybody. Welcome to the Lock in Your Success Options Trading for Income Weekly Update for December 15th, 2014. Before we get going, I'd like to remind you that this presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. The trades shown on this program are hypothetical computer-simulated trades and results, and their presentation is believed to be as accurately represented as possible. However, there are times when live results may vary. If you're watching this on YouTube or some other venue, come on over to our website, check out our programs, the M3, the Bearish Butterfly, the Rock, the M21. We also have group coaching and individual one-on-one coaching and our Trading Triangle program as well. And join our mailing list, get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for this free weekly webinar. And of course, stay tuned for our programs that are currently under development. Okay, let's take a look at what's going on in the markets. And last week I was saying that we were overextended in the SPX, we were overextended in the Dow, and we were overextended in the NASDAQ. And we're due for some sort of at least a mild pullback. And I was kind of bearish for the week. I've been bearish for a couple of weeks. We knew it was coming, we just didn't know when. And last week we finally had at least a bit of a retracement here in the SPX, the NASDAQ, and the Dow. So we essentially got just a pull down to, this is a short-term 60-day chart, 60 minutes, which I like to use for our short-term levels. And in the SPX we got a pull down to just our shorter-term support areas. So if we go to the Dow, we got pretty much the same thing. We were overextended here, got a pullback into our short-term support areas. And again, on the NASDAQ, we pulled down into our short-term support area. So no big surprise that we hit the same thing on the Russell. We haven't been overextended in the Russell, but we've been in more of a fairly wide sideways range. And we pulled back again right back to the support levels. So that's completely normal. In a longer-term context, this isn't much of a pullback. So if we pull to our really long-term charts, this is actually, if we go into like the SPX, for example, just a very mild, normal pullback. The question is now, from this point, is, are the traders still relatively optimistic and bullish, or are the traders, is there enough news on the horizon where they're going to be a little bit more pessimistic and look for a more reasonable pullback? We talked last week, I think I was looking at the Russell maybe going down to 1130 or 1110. I didn't necessarily think it was going to happen in December, because December does tend to be a bullish month in general. The indices usually hold their levels, not all the time, but most of the time. And that being the case, I would expect things to be relatively stable. This is a decent support area on the SPX. If you look at the daily chart on the Dow, again, this is a decent support area, but realistically, another 200 points or so would be a little more realistic for something of a more normal pullback. Same thing on the NDX. I'd expect a more normal pullback around 4,100. And of course, if that were to happen, we'd pull the Russell down into the 1130 to 1110 area, which is more primary support area also. Okay, I'm glad sound came back. I see we're having a little bit of a sound quality issue. If that continues, let me know. I can switch and call in. So anyway, I think this is normal for the month. I would expect at least an attempt at the buyers coming into the market here, and we're kind of seeing that in the futures. Whether it holds up or not, I don't know. Essentially right now it's going to be more news driven. We get some bad news, it will continue down. Some good news, it may go up. I think for December or the remainder of the month, I would think that we hold these levels, or at least the 1130 level and the Russell. Even if we come back down and we pull down a little bit harder in those other indices, I'm thinking we'll be limited for a downside move. Once January comes, it's a different story. For the upside, I really wouldn't expect us to pull much past 1190. On the outside chance we get the other indices breaking to new highs, we may come up into 1210. But I'd say this is a pretty solid level for the year that we should stay inside of. So we're kind of at a decision point. Should be a little bit news driven, and we'll just kind of have to see where we go from here. All right, so we've had, as far as our positions go, we had a lot of price movement last week. We have positions in December. But luckily, we haven't had actually a whole lot of movement as far as we haven't had to move the positions around a whole lot. So let's just take a look at the V Condor first. And this here is what our position looked like on Monday. Remember, we had to buy back a few of these shorts earlier in the trade because it was giving us some trouble with the upside. If we look at our analyzed graph, this is what we look like here. I basically said that if the market pulls back extensively that we're going to sell this V out. And, we pulled back early in the week, which I kind of ignored. But the second pullback I was a little more concerned about. So I went ahead on the 11th, which I believe was Thursday, and I just sold off this 1100, 1120 straddle. And if we come to the end of the week, this is what we look like here. Again, we are looking at 1169. And here's what we got going right here. So I'm just expecting to expire this. As I think we've been saying this for probably 3 weeks now. I was expecting to expire this at a fairly, relatively small profit for the month. It looks like as long as the market does anything reasonable, we'll probably pull about $1,800 or so out of this. If the market takes off too hard to the upside, I may end up just closing it. The downside, gosh, I don't know that I'm really worried about a 1040 short strike. So we'll just possibly close the upside with a very aggressive up move, with a or a down move. We'll just kind of hang in there. And that should be it for December V Condor. As far as the bearish butterfly, we closed that earlier. The M3 and the Rock trade are essentially in the same position, and there were no adjustments for this the entire week. So, we had some up moves, we had some down moves. Through the whole process, we never hit really any maximum delta ranges. So the market did a lot of aggressive moves that kind of fake you out a little bit. But again, if you're staying within guidelines and you were positioned this way, there was really no need to do anything. Despite that, despite being very high theta and having a good Vega number and being relatively flat delta, we haven't seen any position gains. And theoretically, if you were to take your analyzed graph and you were to just take a look at how fast this is supposed to gain value, even if you went back to the beginning of the week, you'd be thinking that we'd be up around $7,000 by now, and nothing's happened. And that's just simply because the market's moving around a lot. We've had a little bit of uncertainty because the SPX and the other indices, except for the Russell, of course, broke some support levels, and that kind of drove uncertainty up. And as we said earlier, if the participants in the market think we may get a fairly large move, it doesn't really matter what the volatility does per se. They're just not going to give you they're not going to take the value out of these short strikes, and that's essentially what's going to happen. What's happened. Now, of course, we're coming into expiration week now. They're going to have no choice at some point but to take at least some of the value out. You will run into some times when, if they think the market move is going to be extreme, they will actually force you to expire one of these to actually get the value out of it. Whether you actually want to do that or not is a personal choice. And how expiring these, hopefully by now, that if you expire one of these, it's not at the Thursday afternoon price, and it's not necessarily at the Friday morning price. It's at the price of the RLS value, which can be outside the range of both of those prices. So you can get some decent moves to where your expiration value is. But if the market's really, really volatile, they may hold the prices down even till that point. I mean, you think you get your money on Thursday afternoon, but not necessarily the case. 90% of the time it is the case, but not every time. So, all right, I got a quick question on this, and it just says, what trade adjustment makes the M3 tent flat on the top? And it's just because these short strikes are separated. So if we look at our position here, because these short strikes are at 1130 and 1160, it's going to give you the flat top. And that would be the same if you had a butterfly here and you had 1130, 1150, 60 verticals in, you'd still get the flat top. So that's what adjustment makes that. So that's essentially this trade. We're just sitting here at break even. If the market settles in the next day or two, the value of this will come in very, very fast. In other words, if the directional traders kind of give up that we're going to have this big move in the next 3 or 4 days, the value will come into this very, very quickly. If we do get that big move that they're expecting, then, I don't know, we may break even on this. If it's a really big down move, you may even take a loss. But well, right now it looks like it may be relatively flat. Still, if I get in the 2,500 range and the market acts up at all, I'd be interested in closing this and just moving on. So, all right, did I sell off 10 of my short strikes? And this is the same trade, the M3 trade. No, I didn't sell them off. I moved them from 1130 to 1150, 1160. So if we were originally in an 1130 butterfly and I sold 10 1130, 1160 verticals, I would put me in this position, which is what I'm in right now. If I pull this up, you'll see the long strike, which is what I'm in right now, and that's the reason for the flat top. I mean, if I took the call out, it would be completely flat like that. Okay, so that's the M3 trade, and the rock trade is identical. So again, no adjustments in the rock trade. If you remember, we entered the rock trade a little bit later, different timing, and this is what we have a bit of a profit and loss difference, but essentially, this is the same trade. We have the exact same short strikes. We're just in a different long strike, and the same thing goes here. If I get a decent profit in here, $2,500, I just assume close the year out and move on. But we'll see what happens coming into the month. If the market just goes flat and this is really mellow, I may end up staying in here. But if we continue to get our fairly rapid movements, then I'd be happy to pull this off 5% and just kind of move on. So those are our December trades. Our January trades are similar condition. Really, we haven't had a need to do anything here. We have our V condor, which is sitting in this position here. We've had no adjustments since entry. We have our 1260 shorts. We have our 1190 shorts. We have our straddle in here at 1170. Positions down a little bit with our volatility increase, but this is still a really healthy, nice-looking trade. No concerns whatsoever. If we do break support and come down, we'll be buying back some of these 1090s, and it would take quite an up move to actually force us to do anything on the upside. So everything's looking good there. If we look at our M3 trade again, no adjustments on an M3 trade. This is what the position looks like. We're a little bit heavy in the butterflies here. We're still, as of our checkpoint, we're still above our short strikes, so no need to roll back. And if we take a look at our analyzed graph, this is what we look like. So no problems there. Everything's going fine there. And I believe the last trade that we currently have on is our January bearish butterfly, which is just an 1160 butterfly at this point. Again, we had the entry. We had no adjustments. This is what we're looking like. So no problems at that. And that's all we have for the positions. Now let's see what we have for some questions here. I have a question that says, which of my strategies works best in the final month if you're break even after the first month? So which strategy is going to work best is going to be completely dependent on the environment, right? So, if you have a very flat environment, the most efficient trade is a condor. If the market's not going anywhere, then that's very, very efficient. The at-the-money options are the last ones to lose their value, so even a butterfly usually depreciates a little bit slower than a condor. And the further you are from expiration, the wider the condor, that's the most efficient. Now, the most efficient isn't necessarily the best because you do need some price movement protection most of the time. If the market's really moving around, you're better off to be in an M3 type of a strategy. If the market's somewhere in between, the rock strategy works very well. So, if I could trade only one trade and I was very efficient and I did well with the M3 trade, I would trade a rock trade strategy because the rock trade is an adaptable strategy. It has an entry test. Well, when you're doing your adjustments, it has tests, at least some sort of a test to check the market environment to see if you should be in a more of a low gamma, low theta price movement protective type of a position, or if you should be in a more aggressive condorish type of a position, and that test is very useful. So that's probably the best type of trade. If I just had to pick one trade and I was going to completely ignore charting, and I wanted to be in a 30-day time frame, I'd be in that trade. It's a very, very dynamic system, and you can see by the results in the last 2 years that it's fantastic results. So that's what I'd be in. I'd be in a rock trade. Of course, in order to be in a rock trade, you have to understand the intricacies of an M3 and a bearish butterfly. But that's the most useful. And of course, it'd be even more useful if you actually identify your market conditions with where you are in your market cycle and what's actually happening in the charting arena too, because if you know what's charting, you could modify that a little bit and do something even more advantageous to what's going on in the market. And we do that in the M21 program. So it depends is the answer for that. Can I talk about the opportunities to convert a January M3 into a bearish butterfly on a bounce? That's a risky trade. I wouldn't do that. You're coming into 35 days to expiration. You're better off if you get a bounce to do your T+0 line checks that you would do in a rock trade. And if it tells you that you're better off to stay in an M3, I'd probably stay in an M3. If it basically tells us that we're better off to go into something more aggressive, I'd probably be more likely to push towards a rock trade, especially with January. At that point, it's going to be, 30 days to expiration or closer probably, right? So it becomes risky in a bearish butterfly that close to expiration, so I tend to avoid that. If I was going to go into a bearish butterfly from a January M3, I would probably go into a February. So that's what I would say with that. What's my opinion on buying weekly put for insurance on the January M3 prior to Fed announcement? January M3, I wouldn't do it. If I was too close to my short strikes, I would prefer to roll back and make my front, in other words, roll back to give myself more room. If I was concerned about that, I personally do not pay any attention to Fed announcements or news. So the thing is, if you buy a put, in other words, if you buy a put on every time you have a Fed announcement, that's very, very costly because the puts are actually overpriced because the market makers have already priced in a fairly significant market movement for all the scared investors. They're actually overpricing that put. If you already had it, you'd keep it, but they're drastically overpricing the put. If the market goes in your direction, you'll probably, if it goes down and it goes down the amount that was expected by the people who know how far the market's likely to go, then you're not going to make any money. The only way and if it goes up or if it's flat, you get killed on it. And if you happen to get that 10% of the time when the market makers are actually wrong and it goes more than they expected, that's when you make your money. But we have to play for probabilities with our trades, and If we play for probabilities, the probabilities is you're better off not buying that. So I would probably tend to go against that. How did the January V Condor get the bar above 0? Okay, so if you go to the January V Condor trade, a lot of times it's below 0. So I think what you mean by that is, if we look at our analyzed graph, a lot of times this is at 0 or below 0. That just has everything to do with the volatility level. The volatility is high. We got more for the short strikes than we did for the straddle that far out from expiration. And let me buy. So it's just a function of the market environment. And you know how on a butterfly, if you do a bearish butterfly, 56 days to expiration, or actually if you do a rock trade, right? So you're 30 days to expiration with a butterfly. Some days you get sometimes you'll get a relatively flat delta. Sometimes the delta will be very, very high. And that can tell you what the market makers are thinking. You have the same situation here where you have a V Condor. You know, sometimes you'll put this trade on and the V will be significantly under 0. Sometimes it'll be over 0. And that's just a function of how the market makers are pricing their options. And you can actually derive some information from that as well, you know, as how far they're concerned about the market moving. And in this case, they're concerned about the market moving a lot. I could adapt this trade to deal with more market movement by adding more straddles in the middle and bringing it down. That would deal with more market movement that way, or I could just leave it. I just chose to leave it. Either way is fine. But that's it. It's just the market's just telling you something. So when would I roll down at January M3? When I hit my maximum delta numbers, or January M3. If I hit my maximum delta numbers, or if we spent time, like towards the end of the day, we're under this 1150 area. If we were pushing towards the 1140 area, I would roll that back. So I'd roll it back for one of two reasons. Again, a delta issue, or or being below the short strikes. I mean, technically, if I'm heavy on butterflies and I have one call in, I may be willing to let this go 20 points under before I roll, but that's going to kind of depend on my delta numbers. So I may let this come all the way down into here, because realistically, it's not really a big deal here. But if I was concerned about a Fed announcement, like another comment I got, or I'm just nervous to the downside, or if I had this feeling the market's going to go down, you know, I might want to roll this back early, but I wouldn't even consider rolling it back above the short strikes. So that's what I was thinking there. Do I use TF to manage delta with big moves? I have students that do sometimes. I never do. Well, I have students that use TF, in other words, in place of buying a Russell call. So so instead of you do an M3, you do this butterfly. Instead of buying a deep in the money call, they go ahead and they buy a Russell future, which is 100 delta, which, you know, basically essentially offsets the position. I don't like to do that. It is actually a little bit more efficient in the manner that you don't have any time value to deal with. It's a little more risky in the manner that if you get a really big down move, the TFs lose money forever, where the call is going to stop losing money, and the volatility increase is going to level you off to the downside. So it's fine to use. If you're using it to manage, if you're using it to guess direction or continue direction on the market, and you're not a directional trader, that kind of defeats the purpose. Most people learn an M3 because they don't want to call direction on the market. If you're using futures overnight and you're playing with the big boys who can know how to day trade, you're probably going to get killed in these big moves 90% of the time. You're usually better off not to do anything. So I would avoid it in that case. Yeah, I mean, which trade is better in a break-even position, 30 days to expiration? It completely depends on what the market's doing. So this is just back to the question: is what trade's the best? 28 days to expiration. What car is the best car to drive? Well, it depends on what the conditions are. I mean, I can say hey, my best car to drive is a 911 Porsche, but if I'm driving up here where I live in the wintertime, when it's snowing out and I have 4 kids I have to transport, over a mountain, the Porsche's not going to do me any damn good. It's going to sit there and it's going to be a real problem. I'm going to want my 4-wheel drive truck to run that out. So you're asking me is a question that all I can put in here is it depends. It completely depends on what the market's doing. There is no right answer for that. And if you're looking for this trade, if you're looking for this answer that, hey, what's best all the time? What's the best ball to use? If you're playing a game, it depends on what game you're playing. It's a very ambiguous question, and there's not really an answer to it. It depends on the market conditions. Can I show the M3 T-log for January or December? I'll show them both. Let me go to here, T-log January, which is just simply our entry. If you want to look at a T-log for December, it's actually the same as last week because there wasn't any changes here. So if I go to M3 December, I'll show you the T-log. This is it. It's actually a fairly long T-log because we had a lot of movement early in the trade. We started way back here at the 1130s. We went way up, and then we had to had a lot of little moves in here. But that is that. What do we have here? I started my January M3 1140 on 1121. Okay. Did I miss your recommendation for opening that one? You started at, you were down at 1140. I mean, that's fine. That's the thing about the M3 traders. It's so dynamic. I might be at 1130. Somebody might be at 1140. Somebody might be 1150. There's nothing like this hard thing where if you're not at 1140 you're going to lose money, or you're not at 1150 you're going to lose money, or whatever. So it's possible that somebody may have started at 1140 depending on time of day of entry. It may have been a judgment call that day, or if you started a day later, I mean, who knows, you might be at 1160. Either way, if I was 1160 I might consider rolling back, but certainly not 1150. But yeah, so that's just completely dependent on that. So I don't think anybody did anything wrong because they're slightly different strikes. Okay, yeah, it's just an option view question. My volatility SV says 16.3, mine says 13.3. I don't know why they're different. You'd have to call option view. I know the software itself puts that number in there, and I don't even know how it calculates that. So I don't know why the difference is there. To be honest with you, I just don't know. So you just have to. I've talked to Option View about that, and they've actually almost sounds like the people I talk to don't know either. So I don't know. I would talk to Option View about that. Market makers are settling values. How does this happen? How many are doing this all at the same time? What's the process? So when the market, okay, so I think this is just a question on settlement value. So our settlement value is just going to be determined by the opening prints of the 2,000 stocks within the Russell Index. Sometimes depending if the market's moving a lot, you can have certain stocks that open not until like 11 o'clock. So you might have these stocks that are opening right on the open, and you have other ones that might be opening when the market's 10 points higher, or you have some other ones that are opening when the market's 10 points lower, and it can kind of throw the value off of wherever the opening value actually was in the Russell. So essentially that's how they determine it. And if you look up the sign RLS, that's going to show you the opening or the settlement values of it's just a regular, looks like a regular chart It'll tell you the settlement values of the options. Sometimes they don't know what the settlement value is till as late as 1 or 2 o'clock on a crazy day. So you'll have to guess with that. If in the January M3, if RUT pulls back near 1140, when I roll a position back to 1120 or just back 20 points, I'll usually roll it back probably 30 points under the market. So if it came to 1140, I might bring it all the way back to maybe 1110. What I'm looking for is I'm looking for a T plus 0 line profile that's nice to the upside and to have a lot of downside room. I don't want to get into this position where I have a really sharp gamma curve. Like if I roll back and I roll back 20 under and I'm in this position that looks like the upper line, then I'm probably going to roll back further. So, okay, my M3 long call, I understand the delta hedge purposes. However, if you're looking to take advantage of gamma and vega of the call, especially on a down move, why not use either stock or synthetic long for delta hedge in order to cut down the delta drag. Selling a short put synthetically the same actually does not react the same as having a large call, a long call, so there are differences. I mean, I have to get in this a little bit more than I probably want to. If you're using a stock, you don't have any volatility advantage if the price comes down. So if I'm long a call, and I mean, if I'm long stock and the price moves down, then I'm not getting a volatility increase, right? So if I have a long option, again, this takes a little bit longer to explain, but if I have a long option, there's a limit in how much I can lose in a long option, rather than being just long 100 IWM. But you know, the original M3 just used IWM stock, and it's because I purposely wanted to get more capital in the trade than was necessary to help keep people out of trouble. As everybody became more well known and known that I use a long call instead, everybody just started using long calls. But there's nothing wrong with using the IWM, except you don't get that vega bump when the market comes down. And plus it costs a lot less money to be in a long call than it does to have in stock. So that's why I prefer the call. And again, if you're shorting a put at the same level, it's not the same as having the stock. I mean, synthetics are the same, yet they're different. So, if I have, now, like I said, it's just too much to get into this now. But anyway, it is a little bit different. Again, you can use a variety of methods. You can use stock, you can use futures, you can use a long call. All of those are effective in a delta hedge. So you can, if you have a different preference, you can certainly do that. But you don't necessarily have to. I mean, doing a long call is fine. Again, there's a lot of flexibility here. Would I recommend a roll of a January M3 centered at 1160 back to 1150? Well, see what the market does today. If the market's down under 1140, or if it's still under 1150 or 1150 area at Tuesday, then I'd probably take it down. But I'd probably take it down further than 1150. I'd probably take it down maybe to maybe 1130. If Russell makes a strong up move, would I consider making an adjustment into like what they call some people call it cheap trade, and hold on to expiration as opposed to closing the trade? I'm assuming you're talking about December. The way I'd want to handle that, and I would be willing to, I go to a December M3, I'd be willing to go towards an unhedged M3. So if the market runs up, I don't know, where's the market now? Yeah, okay, so we're up 13, at least in the futures anyway. So if the market runs up, I'd be interested in adding more verticals in here. And when the verticals create a positive delta problem, I would be interested in starting to drop out of the calls. And if you take that to its extreme, then you would be in that type of a trade, yes. So I would gradually go back to that. January 3, looking for triggers for rollback. I've already talked about that. The M3 has an extra butterfly because on entry it helped me be in a deep enough money call and still have my Greek straightened out, which happens in higher volatility. Sometimes you'll get 5, 6, 7 extra flies on entry. Could I use TF as a short-term adjustment instead of replacing the long call? Yeah, TF is fine for a short-term adjustment. The only thing, it does the same thing. Like I said, you have more long-term downside risk. If the market just completely tanked on you, you have more risk that way. What I get concerned about is people using TF to day trade their position. In other words, all they're doing is they're speculating with short-term market moves, which usually turns out bad for income traders. Right, so if I want to control the upside on a bearish butterfly and you don't sit in front of the screen all day, you could choose your levels and place the market orders there. Yeah, right, yeah, because sometimes the futures have a lot less slippage if the market's going against you than like trying to buy a call. If you're trying to buy a call when the market is going up, for an example, you're going to overpay for it. Where the futures, you tend not to. So yeah, so in that case, that's a good thing to do, as long as you can watch your downside and realize what kind of risk you're taking on. Yeah, then you sell off and add the butterflies later. Yeah, so that's perfectly fine. It's actually a more efficient way to do things. I have people do that. And that, I have to get going, guys. I still have more questions. Keep those for next week. Certainly we won't answer that, but I have another webinar I have to get on, so I'll have to close this out. Thank you for your participation, everybody, and have a great week, everybody, and we'll talk to you next week.